Gold just finished its best month in 27 years, and it did it while every major bank on Wall Street was cutting its price target. Think about that for a second. In August alone, gold rose more than 15%. That is the strongest monthly gain since September of 1999, and it happened at the exact moment Goldman Sachs, JP Morgan, and Bank of America were all telling their clients to expect less. When the experts lower their expectations and the market ignores them, something is happening underneath. That is what we need to talk about today. Let me paint the picture in 60 seconds. In January, gold hit an all-time high of nearly $5,600 an ounce. Then it fell hard. By early summer, it was down 26%, sitting around 4,100. Retail investors gave up. Money flowed out of gold funds for the first time in a year. Then came August. In 3 weeks, gold climbed from about $4,050 to nearly $4,700. On Tuesday, it touched a 3-month high. On Wednesday, it pulled back to around $4,600. The pullback is what everyone is watching, but the pullback is not the story. The story starts with something most people missed. Last week, the United States Treasury quietly doubled the size of its bond buyback program for long-dated debt. In plain language, the government is buying back its own old bonds to keep the market for long-term debt from freezing up. That sounds technical. It is not. It means the Treasury is worried about who will buy 30-year American debt at current prices. And the moment that news landed, the dollar fell to its weakest level in more than 3 months. Gold moved the other way. This is what traders call the debasement trade. You do not need the jargon, you just need the idea. The idea is simple. When a government has too much debt and cannot stop spending, it has 2 choices. It can raise taxes, or it can let the currency lose value slowly. Every government in history has picked the second one. Investors know this, so when they see the Treasury propping up its own bond market, they read it as a signal. The dollar you hold today will buy less next year. Gold does not pay interest, but gold does not get printed either. That is the trade. It is not about fear, it is about arithmetic. Here is the arithmetic that keeps people at Goldman Sachs up at night. The American federal debt is now above $39 trillion. In the first 7 months of this fiscal year, the government paid $628 billion just in interest. That is more than it spent on Medicare in the same period. Read that again. Interest on old debt now costs more than health care for every senior citizen in the country. And every time the central bank raises rates to fight inflation, that interest bill grows. So the central bank is boxed in. It cannot raise rates too far without breaking the budget. It cannot cut rates without feeding inflation. Gold sits right in the middle of that trap and waits. Now let me show you where the big money is actually going, because it is not where the headlines say. The World Gold Council just reported that central banks bought nearly 289 tons of gold in the second quarter. That is up 62% from a year ago. It is the strongest second quarter ever recorded. And here is the part that matters. They bought it while the price was falling. Poland bought, Gaston bought, the Czech Republic bought. The People's Bank of China has now added gold for 21 months in a row. These are not traders looking for a quick gain. These are governments moving their savings out of paper and into metal. Ask yourself why a central bank would do that. A central bank does not care about next month's price. It cares about what happens if the world's payment system gets weaponized. It cares about what happens if the dollar loses 10% of its value over 5 years. Gold is insurance against both. And when the biggest, slowest, most conservative buyers on earth keep buying through a 26% drop, they create something powerful. They create a floor. Goldman estimates that official buyers absorb roughly 50 to 60 tons every month. That is a bid that never goes away. Retail investors sell when they are scared. Central banks do not. So what does this mean for the economy beyond the price chart? When gold rises this fast, it is sending a message about trust. Every ounce that moves higher is a vote against paper money that shows up in ways ordinary people feel. Import prices rise when the dollar weakens. Jewelry gets expensive. Mining stocks become the best performing sector nobody owns. But the deeper effect is psychological. When gold is strong, businesses hesitate to borrow long-term because they do not trust future prices. Households hold back on big purchases. A strong gold market is often a quiet economy. That is the part the cheerleaders forget. Let me bring in the other side because there is one. JP Morgan is nervous. In early July, they cut their fourth quarter target to $4,500. That is barely above where gold sits today. Their reasoning is that industrial demand is weak, and investor interest has been fading. Goldman is more optimistic at $4,900 by year-end. But even Goldman has a warning attached. If the central bank actually raises rates in September, they see gold sliding back to $4,400. And right now the market is pricing roughly a 44% chance of exactly that, not a small number. That brings us to Friday. The new chairman of the Federal Reserve, Kevin Warsh, speaks at Jackson Hole. Every gold trader on the planet will be listening. If he sounds worried about inflation, gold could drop $200 in an afternoon. If he sounds worried about growth, gold could run to $5,000 before the month ends. Nobody knows which version shows up, and that uncertainty is exactly why the price has been swinging $100 a day this week. The metal is not confused. The people watching it are. Now let me describe 3 real investors I keep seeing in the comments of channels like this one. The first one sold in early August. Gold had fallen from $5,600 to $4,050. He had held through the whole drop and he finally could not take it anymore. He sold at the bottom. 3 weeks later, gold is up $600. He is not angry at the market, he is angry at himself. And that anger will keep him out of the next move too. The second investor has been sitting in cash since January. She looked at the all-time high, decided gold was too expensive, and waited. She was right for 5 months. Then she was wrong for 3 weeks. Now she is staring at $4,700 and telling herself it will come back down. Maybe it will. But she has been saying that for 2 years while gold doubled. Being right about a pullback is worthless if you never buy the pullback. Waiting is not a strategy, it just feels like one. The third investor is the dangerous one. He saw the 15% August rally on the news and bought on Tuesday, at the 3-month high. He has no plan, he has a feeling. Daryl Fletcher at Bannockburn Capital said it well this week. Buying high and hoping for higher in the short term is a hard way to make money. Gold can go to $5,000 and this investor can still lose, because he will panic on the first 4% drop. He is not investing in gold. He is investing in his own excitement. If any of those 3 sounds like you, do not feel bad. Every one of them is human. Howard Marks has spent 40 years writing about this. He says the biggest risk is not the asset. It is the crowd's mood around the asset. When everyone hates gold, it is usually cheap. When everyone loves it, it is usually late. Right now the crowd is somewhere in between. Retail is confused. Banks are cautious. Central banks are buying. That mix is unusual. And unusual is where the opportunity lives. Let me give you one short piece of history. Because this pattern has happened before. In the 1970s, gold went from $35 to $850. But in the middle of that run, from late 1974 to 1976, it fell almost half. Most people who sold during that drop never bought back, and they missed the biggest part of the move. The same thing happened in 2008. Gold fell 30% in the panic. Then it doubled over the next 3 years. The lesson is not that gold always goes up. The lesson is that the middle of a long trend always feels like the end. So what happens if you sit still for 6 months? Let me walk through it without pretending I know the future. If JP Morgan is right, and gold drifts to $4,500, you lose nothing by waiting. If Goldman is right, and it reaches $4,900, you miss about 6%. If the more aggressive banks like Wells Fargo are right and it pushes towards $6,000, you miss 30%. Meanwhile, cash in a savings account earns maybe 4% before taxes, and the dollar itself just dropped to a 3-month low. So sitting still is not safe. It is just a different bet. Made quietly, with no one watching. And notice one detail about who is buying this dip. Dealers say retail buyers of physical coins are using the pullback, not chasing the spike. Premiums on old American gold coins have stayed firm all week. That is a different crowd from the fund investors who fled in June. Physical buyers rarely sell. They put the coins in a drawer and forget them for a decade. When that crowd shows up, the supply of gold that is actually for sale gets smaller, less supply, steady demand from central banks, and a weakening dollar. That is not a prediction. That is just the shape of the market right now. Ray Dalio has a phrase for this moment. He calls it the late stage of the debt cycle. His argument is that when a country's interest bill starts crowding out its real spending, the currency becomes the release valve. He is not predicting a collapse. He is predicting a slow leak. And in a slow leak, gold does not spike it. Grinds 15% one month, down 5% the next, up 8% the month after. That is what the last 2 years have looked like. That is probably what the next 2 years will look like too. The question is whether you can hold something that boring. One more thing worth noticing. China's gold imports through Hong Kong rose 11% in July. Silver is above $67 an ounce, and it has been climbing alongside gold all month. Oil is falling, which takes pressure off inflation and gives the central bank a reason to stay patient. Every one of those signals points the same direction. The demand for hard assets is coming from the East, from governments, and from people who have already lived through a currency losing value. Americans have not lived through that. That is why they are the last ones to believe it. So here's where we are. Gold had its best month since 1999. Wall Street cut its targets and the market laughed at them. Central banks are buying at record pace. The Treasury is propping up its own bond market. And on Friday, a new Fed chairman will say a few sentences that could move this whole thing $200 in either direction. That is the setup. Nobody can tell you what happens next. But you can decide which side of the table you want to sit on before it happens. So tell me, are you moving into gold now? At 4,600? Because you think the debt math is finally catching up? Or are you waiting for the drop back to 4,000 that JP Morgan seems to expect? Are you the one who sold in August? The one who is still waiting? Or the one who just bought the high? Put your answer in the comments. I read every single one, and I want to know which side you are on. Everything here is for informational purposes only. This is not financial advice.